Portfolio designing. It's one of my main responsibilities as a financial advisor to design and manage portfolios for my clients. Now, occasionally you'll hear me talk about different numbers like an 80-20, 60-40, 70-30, and basically what I'm saying is the designation of stock to fixed income. So 80-20 is 80% stock, 20% fixed income. 70-30 is 70% stock, 30% fixed income, and so on and so forth. Now, when I say stock, I don't usually mean individual stock. I do have clients who own individual stocks, and I own individual stocks myself, but they're rarely used by financial advisors today. We use more ETFs and mutual funds to give the client the benefit of diversification. Now, fixed income or bonds, I hardly ever talk about fixed income or bonds on this channel, and people don't really have that much of an interest in fixed income and bonds. And it's unfortunate because they really do play a large role in the ecosystem of investing. And bonds are actually, in my opinion, a lot more complex and a lot more interesting than stock. Think of a bond as a debt, usually by a corporation or a government or another entity, and they're paying interest on that debt. There's everything from A quality to junk quality bonds. Most financial advisors, I rarely do transactions for individual bonds. Reason being, individual bonds are incredibly complex and very hard to manage, especially in a portfolio. I do have clients who have bond portfolios, and they probably take 10 times the energy to manage over a stock portfolio. There's also bonds that are called, bonds that come due. How much is this bond paying out? When is it paying out? Am I going to be able to replicate the returns on this bond when this bond comes due? And what is the current value of the bond? Those are all things that have to be measured in a bond portfolio. So most financial advisors, wealth managers, instead use ETFs or mutual funds that specialize in bond management, and we just let someone else handle the management of the bond funds. Why am I talking about all of this? This is important because I wanted to do a video, and I got a very important question on a recent video on a $2 million retirement portfolio on the difference in returns from an 80-20 portfolio to a 60-40 portfolio. And I thought it was a very interesting question because I put these terms out regularly on my channel, but I don't think some people understand the implications of the different portfolio types. And there are huge implications in deciding whether to go with an 80-20 portfolio or a 60-40 portfolio. Typically, most retirees, by the time someone is in their 70s, they've gone to a 60-40 portfolio. And with the addition of bonds or fixed income, it's basically I'm rearranging risk. I'm shifting risk out of the stock market more to the fixed income market and balancing the portfolio to basically be able to weather shocks to the market better. Reason why that's important in retirement is because during an event like 2008 or 2022, you're not going back to work. You're not going to be able to earn more income. You have to live with whatever resources you have on hand. And so you need that portfolio to behave in a more stable and predictable manner than when you were younger and could handle more shocks to the market. But I think it's really important to look at historical returns and see the actual dollar amount difference. A 100% stock versus 80-20 versus 60-40 portfolio will put off in the long term. And maybe it'll help shape your thinking in deciding what portfolio configuration is right for you. Now, I'm not recommending any of these portfolios to individuals because recommending a portfolio configuration is a very customized experience. It's based on the person's age, income, risk tolerance, and goals. People can have multiple portfolio configurations. One person may have a 90-10 split on one portfolio, but a second portfolio that they have may be 50-50, and the difference simply may be the time frame that they need that money. And some people hold the same portfolio configuration across all accounts, and it has to do with personal preference and risk tolerance. I'm actually going to switch to my computer, and I'm going to show you what the difference in the different portfolio configurations can produce over a 20-year period of time. Stay with me. Okay, here we are at my computer screen, and I'm about to reveal the numbers with the last 20 years of data, meaning data starting in 2023 and ending in 2023, the difference between 100% S&P 500 an 80-20 portfolio, and a 60-40 portfolio. Now, I've used the 80-20 and the 60-40 numbers a lot in my other videos on retirement. These numbers are going to be slightly different. Why are the numbers on returns slightly different? Because I'm using slightly different bond indexes to run these numbers. For my other videos, I use the S&P 500 US aggregate bond. And for this, I'm actually using the Bloomberg US aggregate bond numbers. And the outcome differences are slight, but there are differences in the numbers, and that is why. I'm going to show percentages, and then I am going to show the dollar amounts, put a dollar amount to it so you can see the real impact of the different rate of returns and these portfolios. Now, in terms of portfolio configurations, typically whether the person is 100% stock or 80-20 or 60-40 is dictated once again by stage of life and age. I do have some very young people who are in 60-40 portfolios, and I do have some very old people who may not be 100% stock, but they may be like in a 90-10 portfolio and they really want it that way. I am not giving any recommendations based on this video. Please talk to a financial advisor or wealth manager before you decide on a portfolio configuration that is right for you, or you design your own portfolio. I myself do a lot of things in my own personal portfolios I would never do in a client's account. I would probably be fired if I did it in a client account. It's because I understand the level of risk that I'm taking on, and I understand what I'm investing in at a level that I feel comfortable doing that. But everybody has a different risk tolerance. Everybody has a different goal. There's no one correct answer for this equation on which portfolio profile you should select for yourself. There's also other portfolio configurations. There's a 50-50 portfolio configuration. There's 40-60, 30-70, and 20-80. I have had a handful of clients who went 20% stock, 80% fixed income. And typically those people were very elderly and needed the portfolio for immediate needs, but also needed to maintain a certain level of growth in order to keep up with the inflation that occurs in healthcare. So we do have portfolio configurations that are different than these three, but I would say probably 85% of my portfolios fall into one of these three buckets or somewhere in between these three buckets. Maybe it's a 70-30, maybe it's a 90-10, or, maybe it's a 50-50, but it's somewhere in the spectrum. So let's look at returns. Okay. So for the past 20 years, this is just pure S&P 500. The returns on the S&P 500 for the past 20 years has been on average about 10%. There's been some really spectacular years, like, 2013 was a hot one. 2019 was great. 2021 was fantastic. 2023 was great. But there's also been some super trash years, like, of course, 2008, the year that will live in infamy in many people's minds and spirits, and some years of flat growth, like 2011, 2015. And once again, 2022 was a pretty bad year for both the stock and the bond market. Okay. But these are the overall returns. And when you average them all together over a 10-year period of time, it's a return of about, on average, 10% per year on the market. Now, the S&P 500 is one index. There are many different indexes, and the S&P 500 takes a very specific slice of the American stock market. There's also the Russell 2000. There's a million different indexes that you can look at. It depends on exactly what you're trying to measure. But the S&P 500 index is the one that is most broadly applicable to the American public, and probably the one that's most familiar to the American public. So financial advisors use it a lot. The big question that I have received is, are there funds that can beat the S&P 500? Yes, there are. There are some funds that consistently beat the S&P 500 index fund. Here's the problem with those funds. They take on an enormous amount of risk. They're doing things like leverage. They're using derivatives hedges, or they just invest in a super risky segment of the market. And many people cannot handle that level of risk when you explain it. Instead of in 2008, instead of losing 38%, maybe this fund lost 68%. but it came back, with a 50% return the following year. They're really dizzying highs, they're really dizzying lows, there's everything in between because these instruments are employing high stake strategy to secure that very high rate of return. Can they return more than 10% on average over the long run? They can. I really encourage, because there's a lot of DIY do it yourselfers in this crowd. And I love the do it yourself crowd. They're a lot of fun and very knowledgeable and very interactive people to deal with. But for people who want to get into very specialized products that utilize leverage, products that utilize or backed by derivatives or hedges, that's when you really need to get a financial advisor on board, because I've seen people completely financially obliterate themselves getting into leveraged products that they did not understand were leveraged to the gods. And when interest rates spiked and inflation hit, these leveraged products were hit super hard. And a lot of clients were left holding the bag because they didn't understand the nature of leverage and how it's very sensitive to interest rates and changes in inflation. So, if you're doing just the S&P 500 or you're doing some plain Jane investing, you want to be knowledgeable, you want to educate yourself to the best of your ability, but the DIY route is the right answer for some people. But if you're moving into more exotic products that utilize more exotic investment strategies, leave that to the professionals. So let's switch over to the 80/20 portfolio return. Okay. So the 80/20, you'll see there's a difference between the S&P 500 and the 80/20. And it's hard to calculate on year to year what that difference between the two performances will be. And the reason being, it's because of the performance of the bond market. 80% of this portfolio is the S&P 500, but this variation in performance is due to the variation that's occurring in the fixed income side and the bond market. And you'll notice for most years, and I'll go over this in greater detail, the S&P 500 Index fund beat out the 80/20 portfolio. There are some years where the 80/20 portfolio was actually the portfolio that came out on top. Typically, think of fixed income or bonds as stabilizers in a portfolio. It stopped things from going off a cliff during really dark times in the market, but it gives people potential for upside capture during those really golden moments in the market. But the upside capture will always be muted because that's the price to pay for having shock absorbers in a portfolio. So let me reveal the 60/40 portfolio now. And we can kind of compare the three at this point, starting in 2003. So, 2003, the 100% S&P 500 Index fund gained almost 26.5%. The 80/20 gained almost 22%, and then the 60/40 gained about 17%. Now, in 2003, the right answer was the S&P 500. That had the superior performance. But hey, I will certainly take a 22% performance in a year as a performance on an account. But certain years, for example, 2007, the S&P 500 returned about 3.5%. The 80/20 portfolio returned about 4.2%, and the 60/40 returned about 5%. Why is this happening? Why does something like this happen? It has to do with something going on in the bond market. And there was a lot of movement happening in 2007 in the fixed income market around mortgages. The CDOs and the mortgages that kind of went belly up in 2008. There was a lot of movement going on in 2007, and it was reflected in the stock market. This year, you actually want it to be in the 60/40 portfolio. 2008 is another year where the 60/40 portfolio totally came out on top. If you were in the S&P 500, it was really dark times. You lost almost 40% of your account value. 80/20 portfolios lost about 31%. But hey, if you were 60/40, you lost about 21%. You were still upset, but I mean, it almost half the risk to have bonds in the portfolio. It stopped a lot of people's portfolios from going off the edge of a cliff. 2011 is another moment. The S&P 500 was flat. 80/20 about 1.5%, 60/40 about 3.12%, 2015 was another year. 2018 was another year you wanted to have the 60-40 split. 2022 is another good example. Now, this one is a little bit unusual. Negative 18% on the S&P 500, 14% on the 80-20, and 16% on the 60-40. This is very rare that you'll see something like that because something really special was happening in 2022. Has to do with the bond market, it has to do with inflation, and it has to do with interest rates. It's very complex. It was a very complex interplay of things because we were coming out of the pandemic, but we ended up with this portfolio configuration. And so if you look at 20 years of time, 6 out of the 20 years, you would have done better with a more conservative portfolio. And for some people, they're very loss adverse, or they're very, have a very low risk tolerance. And that really makes a difference for them to go towards a more conservative profile. Now, if you look on average, the S&P 500 returns 10%, 80-20 returns 8.76%, and the 60-40 returns 7.33%. All respectable returns. But over a 20-year period of time, those differences, those very minor differences, because here it just doesn't seem like that much money, right? It doesn't seem, there's maybe 2.5% return difference between the 100% S&P 500 index and the 60-40 portfolio. You're like, well, what difference does that make? It's not a huge difference. It's not a big deal. Over a 20-year period of time, it's an enormous deal. It's an enormous deal. And I'm going to put dollar figures to all of these amounts to show you the difference between 100% S&P 500 and a 60-40 portfolio, because when you see the dollars, it's really quite shocking. Okay. So let me go back to the top, and let's say an individual had a sudden influx of money. They received a bonus, they received an inheritance, or they sold a house, and they had $250,000 that they invested in the stock market on January 1st, 2003. Okay. So if this person invested it just in the S&P 500 Index fund, by the end of 2003, they'd have $315,000. Okay. 2008, they really built it up over some nice years of return. By 2007, they had $417,000. 2008 took it on the chin. It was back down to $256,000. And I've seen situations like this, like in 2022. And this is gut wrenching, especially for new investors. You're basically back at square one. You've lost 5 years of investment over 1 year. And a lot of people want to throw in the towel at that point, but that's where you have to encourage people to stay the course and not move money around, because look what happened in 2009, 316,000, 2010, 357,000. And this keeps going along and going along. And by the end of 2023, on December 31st, 2023, this person would have just north of $1.4 million sitting in that investment account. They didn't have to add another penny to that $250,000. They didn't have to move things around. Now, 1.2 million of this is subject to capital gains. You deal with that later. But they had significant growth on this account by just having the S&P 500 index fund and not moving things around. Okay, so let's look at the 80-20 portfolio. Okay, so 80-20 portfolio, once again, this person on January 1st puts in $250,000. By the end of the first year, they have $304,000. By 2007, they have $391,000. 2008 comes and and kicks them right in the gut and leaves them with $270,000. They quickly start building things back up. And by December 31st, 2023, this person has 1.2 million. Okay, not so bad. 1.2 million, you can deal with that. But there's a significant difference between 1.4 million and just north of 1.2 million. So this person decided to forego a six-figure amount in returns just for a smoother ride over the 20-year period of time. And maybe if this person was, 60 when they put their money in, this made more sense. But if this person was 30, maybe this made more sense. But like I said, it depends on a bunch of factors, including the person's risk tolerance, goals, and objectives for the money. Let's look at the 60-40 portfolio split. Okay, there we have it. So December 31st of 2003, they have $293,000 after a year of being fully invested. 2008, they get their legs kicked out from under them. But look at this. They have $294,000 while this person has 256,000. So this 60/40 portfolio basically put structure in place so the bottom didn't fall out of the portfolio in 2008. This is critical for an older person over here. This is critical to have the safety brake in place. If I'm 30, I don't really care about the safety brake because I have so many years to make it up. But if I'm 80, I don't really have that much time to make it up. We go on and on. And in 2023, after 20 years, on December 31st, this person has 989,000, still a significant amount of money. This is not an amount to sneeze at, but this is over $400,000 less than if they had just put it in the S&P 500 Index fund. So it sounds minor, 100%, 80, 20, 60, 40, but it can make huge, huge differences in returns over extended periods of time in the market. And it's very important to pick the proper portfolio configuration for your age, goals, risk tolerance for that money. I don't encourage people to go more aggressive just to go more aggressive. You really have to look at that individual's age as well. Because if this person is putting money in at 70, maybe they know the odds of them making it to 90 are more remote than if someone puts the money in at 40 and the odds are that they are going to make it to 60. So there you have it. That's how a financial advisor looks at various portfolio profiles and makes decisions on how we invest client money. If you're a do-it-yourselfer or just interested in learning more information about your portfolio and your money, I hope this information was useful. If you found this information useful, please like, please share, and please subscribe. Thank you.